This is Module 4 of Accounting 3110, and this module is going to look at two different product costing systems, which we will call absorption or full costing, and the alternative being variable costing. Before we turn to that subject, let's go back to Module 3, where you learn to construct a flow chart showing three different types of product costs, three different inventories, and we learned how these costs move from left to right across the flow chart, and ultimately the costs all end up in the cost of goods sold. You see the flow chart in front of you, and in this particular case number 1, which is the for practice from Module 3, we were given some information, and then there were other numbers that it was our task to try to find those numbers. So to work one of these cases, it's necessary to draw out your flow chart and also a basic income statement. So first, let's put in the numbers that we have. The sales were $9,300, gross profit $3,500, net income $2,200. We were also told that we had $500 of beginning work in process. We were told that we had $6,200 was our cost of goods manufactured, which is the cost of the goods completed during the period. That's why the cost is being shown on the right side of the work in process account. We were also told that ending finished goods, we'll draw the line there, ending finished goods would be $1,200. I believe the only two other pieces of information, we were told what prime costs were and what conversion costs were. So let's be sure we understand that prime cost represents direct material plus direct labor. So the prime cost was given to be $3,700. And then we were told that the direct material used, and this would be coming out of the direct materials account, was also $1,200. Now let's look at that for a minute. If we know that prime is material plus labor, and we're told that prime is $3,700 and material is $1,200, then it's easy to compute direct labor at $2,500. So prime cost is a term that we should be familiar with. Conversion cost, this is prime, but conversion costs represent direct labor plus overhead, and in this case it was $4,800. And if we understand that $2,500 was direct labor, it's easy to find that overhead was $2,300. So prime cost, material plus direct labor. Conversion cost, direct labor plus overhead. What we're going to see is that the material comes in, the labor comes in, the overhead comes in. So let's add the material, the labor, and the overhead. $1,200, $2,500 for labor, and overhead is $2,300. Let's look closely now at this work in process account. We saw the material, labor, and overhead being added to the beginning. So if we add up all of these costs, then we know that these costs either have to be in ending inventory, which we'll put right here, or sent out to finished goods because they were completed, and we're told that's $6,200. So when we add this up, we get $6,500. $6,200 went out of this inventory account, so we end up with $300. 62 plus 3 is 6,500 equals all the cost here to be accounted for. Let's move over now to the finished goods inventory. And In fact, let's go all the way over to the income statement and complete it, because it will be helpful to go ahead and get our cost of goods sold. So we understand this must be $1,300, and cost of goods sold, filling in the blanks, would give us $5,800 for cost of goods sold. Cost of goods sold being $5,800, that means that $5,800 came out of finished goods this period and was finished, going to cost of goods sold. All right, so let's look at this account. The $6,200, the cost of goods manufactured, will come into this account. Now, what we do here is we have $6,200 and some beginning inventory that must equal the total of the ending and the cost of goods sold. If you look over in work in process, we added all these up and they had to equal ending plus sent out. What we're doing here is we have ending plus sent out equaling, in this case, $7,000. So $7,000 must also be represented in this area, giving us $800 for beginning inventory. So some of the blanks that we found and could complete: SG&A $1,300, cost of goods sold $5,800, beginning finished goods $800. We have found ending to be $300. This is ending work in process, and we were able to determine materials, labor, and overhead cost because we were told information about both prime and conversion cost. Let's return to today's Module 4 in the subject of absorption versus variable costing. To get our mindset for this particular module, we have to go back to what we've learned in the prior modules about what we mean when we say product cost and period cost. We know that product cost attached to the product, these are inventoriable cost, where period cost do not attach to the products that we make, and period costs are simply expensed every period in which they're incurred. If we think about what we called product cost, we were including direct material, direct labor, and all of factory overhead. Now think about what we're saying here. We have materials we can trace, labor we can trace, and a whole area of cost that we can't trace, or that is indirect, and this is called factory overhead. Now, when we have factory overhead, even though it's all indirect, some of it may behave in a variable nature, some of these costs. Other costs may behave as fixed cost. So just focus for a moment on this area of costs called overhead and think about what types of costs might be variable. For example, we could have a quality control inspector who's paid by the hour. This would be a variable overhead cost. Another example would be those materials that we call indirect materials. These would be considered a variable overhead cost. If we weren't producing anything, we wouldn't have indirect material cost. So what would be some examples of overhead that would be fixed? Well, this could be rent on the building. This could be the insurance on the building. This could be depreciation on the equipment in the factory. Or this could even be the salary of the plant manager. So we have come to the point now where we can really see how this cost terminology becomes very important to us. We're talking about product cost, and we're using the words direct and indirect to describe whether the cost can be traced. We're using the terms variable and fixed to tell us about how the cost is going to behave when the activity level increases or decreases. Now, when we include direct material, direct labor, and all of overhead in the product cost, and this is what we've done up to this point, this is called absorption or full costing. What happens in this type of system when we have selling, general, and administrative expenses? Well, we learned earlier that these are not inventoriable costs and they will simply be expensed. So what we are talking about is this type of costing called absorption or full costing, which is very appropriate and required by GAAP to be used when we produce our statements to go to external users. The reason GAAP requires us to use absorption costing in the statements is because of the matching principle. The matching principle says that we should include all cost of manufacturing the product, and those costs should be expensed in the same period in which revenues are earned, which would be in the period that we sell the product. The problem with this type of costing, again called absorption costing or full costing, is that it may not be appropriate when we are looking at internal reporting, getting information or income statements to decision makers or managers inside the company. The issue becomes the timing of expenses, and specifically the timing of when we expense this area of cost called fixed overhead. What you see in front of you is a description of how we cost out a product using absorption or full costing. We take the direct material costs per unit plus the direct labor costs per unit plus the variable overhead costs per unit. And then when it comes to the fixed overhead, if you will notice, we are going to take total fixed overhead for the period divided by units produced, and it's very important that you recognize we're going to use the units produced, and we can find also a fixed overhead per unit. So all of this would be added to give us total product cost for 1 unit of product. Now let me introduce you to the other type of product costing system, which we call variable costing. There's really only one difference between how we cost a product under absorption and how we cost this product under variable costing. The key difference is what we do with fixed overhead. You see in front of you now a formula for computing the product cost using this new method called variable costing. It looks very similar, but what is missing is the fixed overhead component. In variable costing, you only include those costs which are variable to determine the product cost: direct material, direct labor, and variable overhead. And please be reminded that direct materials are variable as well as direct. That direct labor is also variable. In other words, when a cost is variable, it increases proportionately as we increase the activity level. And again, let's point out the difference is under absorption, fixed overhead was included in the total product cost. What will happen when we contrast these two systems is actually if inventory levels remain the same, in other words, if we're not building inventories or not decreasing our inventories, if they stay the same, these two different product costing systems will give us exactly the same profit for the period. However, if we have a situation where inventories are building or declining, and this would be because sales and production, the number of units of each, would differ, then we will see a different net income under each of these approaches. So let me say that again. What causes inventories to build would be that we produced more than we sold. What would cause inventories to decline would be that we sell more than we produce. So the point here is that these two different product costing systems are going to give us different profits depending on which direction the inventory goes, up or down. But let's say this, and we'll try to say it multiple times, is that GAAP requires for financial reporting to external users that absorption costing, the full costing, including the fixed overhead, is the only method acceptable. So GAAP requires absorption. Variable costing, though, may be in many cases more appropriate for decision makers inside the company. So it's not that one's right and one's wrong, but the point is, when is it appropriate to use each? Let's look now at the information that you have in your lecture notes for this module about a company that sells pencil boxes. And let's quickly get together the information about this product. It sells for $8. Direct material cost is $3.50 for the direct labor, 25 cents for variable overhead. And as you can see here, we're looking at all the information that would relate to the problem, and then we'll look at it from the perspective of absorption costing and then variable costing. According to the information provided, we had $100,000 of fixed overhead for the period, and this is going to be producing 50,000 units. So we would have $2 in fixed overhead per unit because of the production being 50,000 units. Let's go up here in the corner. We have $50,000 units that are being produced, but only 40,000 sold. Now you can see what's going on here is that we have a situation where produced units are greater than sold units by 10,000 units. Let's look at the SG&A too. It has both variable and fixed components. The SG&A is going to be computed every period as 75 cents times every box of pencils that we sell, plus $30,000 in fixed cost. Now again, all we've done is to go through the details of the problem. What I want us to do now is let's take a look at how we would cost the product or the pencil boxes under each of these two methods of costing. So we're going to return to absorption costing, which again is what GAAP requires for our external statements. We have $3 direct material, 50 cents of direct labor. We have 25 cents of variable overhead. We have $2 of fixed overhead. Again, remember that we took the total overhead and divided it by the units produced. And this gives us a total product cost. So this is what one pencil box cost under absorption costing. Now, let's go to variable costing. And we will do the same thing where we will look at what does 1 unit of product cost when we use this type of system. Remember, variable costing is only going to include the variable components and is appropriate for internal use only. $3, 50 cents, 25 cents, $3.75. All right, so what we can do now is let's put together an income statement for each of these. We'll start with absorption, and we will look at a full income statement using the cost information that you had here under absorption costing. All right, we're going to be selling 40,000 units times $8. So this is sales of $320,000. Our cost of goods sold. Well, let's go back, and we have Under absorption, we have a cost of 5.75 times the 40,000. 40,000 units sold at 575. And this gives us $230,000 in cost of goods sold or gross profit of $90,000. Now let's look at those SG&A. It's going to be, let's put that down here. SG&A is going to be 75 cents per unit sold, and we're selling 40,000. So that's the variable. And the fixed is going to be 30,000. So we are going to have, oh, I'm sorry, this is not 75. This is 25 cents. So let's correct that. 25 cents per pencil box that we sell. So we will have a total of $40,000 in SG&A. Let's go back to and let's correct that on our information sheet where we were putting all this information together. And I will correct mine and you can correct yours as well. The variable on our sheet should say 25 cents per box sold, not 75. All right, so we have 10,000 plus 30,000 equals 40,000. And so we have a net income of $50,000. All right, now this is under absorption. Now let's just look at the variable and see what the statement would look like. Of course, the sales are still the same. The variable costs now, remember that this would be material, labor, and variable overhead. This is the total cost of our product, which is all variable. 375 times 40,000 units sold. And we will get 150,000. And a contribution margin of 170. Now, here comes the big difference. What we're going to do, you remember the fixed overhead was 100,000 per period. Under variable costing, we directly go to expense with the factory overhead, or excuse me, the fixed factory overhead. Remember, in absorption, it becomes part of the cost of the product. But in variable costing, fixed overhead is going to be expensed just like the SG&A, which we found to be 40,000. So the key difference that we're seeing, we'll put them both here so you can see them at the same time, is that under variable costing, we are expensing factory overhead and SG&A. In absorption costing, we're only treating SG&A as a period cost. And the fixed overhead is part of our cost of goods sold. Now, let's take a quick look at the outcome here again. You have $50,000 of income under absorption costing, but only $30,000 under variable costing. There's a formula that you can always reconcile the differences between these two approaches. If you would take the fixed overhead per unit, which we recall to be, $2? And you take it times the change in inventory, which in this case we had 50,000 produced, but we only had 40,000 units sold. So it would be 10,000 units. And in this case, our inventory was building. The difference in net income is simply the $2 times the 10,000, which is $20,000 difference. And of course, that's what we found here. So this is an important reconciliation formula. It's an important one to know. If you know the fixed overhead per unit and you know the change in inventory, you can already tell the difference that you will get in net income between these two methods, absorption versus variable costing. Now let's take a closer look at what happened to the fixed overhead under both of these systems. Remember, the key difference is fixed overhead. So what happened? When we use variable costing, we treat fixed overhead as a period cost. So this means the $100,000 is going to be expensed. And every period you would see $100,000 of fixed overhead being expensed, regardless of how sales and production related. It would always be the same. It's a fixed cost. It's the same every period and would be treated as a period cost on the variable income statement each period. What happened in absorption costing? Well, it's treated as a product cost. And what happened to that 50,000 unit or those 50,000 units that we made? Each of them had $2 attached for fixed overhead. Well, we only expensed 80,000, and this was done through our cost of goods sold, because 40,000 units were sold and there was $2 of fixed overhead in each. So 80,000 went to the income statement through the cost of goods sold. What happened to the other $20,000? Well, 10,000 units remained because we produced 50,000, we only sold 40. So we have 10,000 units left in inventory. They carry $2 of fixed overhead per unit. And so $20,000 remains in ending inventory. All expensed under variable, but under absorption, the 100,000 is divided between what went through cost of goods sold and what remains in the asset account called ending inventory. Now let's do one final step to explain this ending inventory. Under absorption costing, we had $3 again, we had 50 cents for labor, we had variable overhead of 25 and fixed of 2, so $5.75 was our cost per unit. If there are 10,000 units in ending inventory, then we would be able to see that the value of the ending inventory would be $57,500. Again, our asset value. Under variable costing, we only had the $3, the 50 cents, and the 25 cents, which is $3.75 times 10,000 units equals $37.5. So there we see the $20,000 difference in net income relates to the $20,000 difference in the way the ending inventory is going to be valued under these two systems. So I hope these examples help you understand the differences in the two, and most importantly, when is it appropriate to use each. Again, GAAP requires the use of full costing or absorption costing for all external statements. When managers and decision makers need assistance internally, and they're going to be using income statements, in many cases it's more appropriate to use the variable costing style of statement. But I would add that this variable costing income statement contains numbers that reflect the cost structure of this company. This would be highly confidential information and something that you would never want to go outside the business.